So gold dropped 6% in a day, screams the headline, screams the Bitcoiners that have come out all over Twitter to try to hack on gold, but I'm not worried about it. I'm Keith Weiner, CEO of Monetary Metals, and let me tell you why. In gold terms, the dollar went up 4.6%. So the dollar caught a bid, the dollar went up, and we can talk about all kinds of reasons why, leverage, other crunches and little problems in the monetary system. But when you look at it that way, I find that when you look at a given system with the right model, with the right lens, the right paradigm, things become simpler. If you think that gold went down, was gold in a bubble? Okay, it went down because it crashed, because of this, it's complicated. And there's all these narratives and all this he said, she said, blah, blah, blah kind of stuff. You can look at the technicals, you can look at this, you can look at that. But when you realize that the dollar is actually valued because gold bids on it, which is our view, and we've written tons of material as to why, and okay, the dollar went up a little bit. Okay, so what? So the dollar went up. And does that mean that you really want to go all in on the dollar? Most people have somewhere between a 2% and maybe a 10% exposure to gold. And now they want to get rid of that and be all in on the dollar, have 100% of their bets on dollar, only dollar. Is that really the right move? I can't give financial advice. And if you need, short-term, dollar liquidity to pay dollar-denominated liabilities, or else you're going to be declared insolvent and the bank will seize all your assets. You may want to have dollars to service that. Gold may not be a safe bet if your horizon is tomorrow or maybe next Monday. But, beyond that, nothing's really changed. The dollar system is still hopelessly hopeless. The other currencies are even more hopeless. If you really don't love the dollar, what do you think of the Argentinian peso right now? What do you think of the Indian rupee right now? What do you think of the Turkish lira right now? They're only worse. So the other currencies range from a little bit worse than the dollar to a lot worse than the dollar, and they're all dollar derivatives. And that's why people's around the world, I almost said to somebody on Twitter, you think everybody's selling the dollar and nobody values gold. Come visit with me here in Dubai. I'll take you to the gold souk. You may have a different perspective on nobody valuing gold. It's absolutely going, bananas in this part of the world. So a lot of people say, hey, gold betrayed its safe haven promise. Gold's supposed to be a safe haven. If gold can go down 5 or 6% in a day, it's not a safe haven. Forget about it. I'm done with gold. Okay, look, if your time horizon is 24 hours and you want to look at the single biggest gold event, I think since I've been following it, at least 12 years, but I think a lot longer than that. And from that, make your judgment and you define everything. Safe haven is only, 1 day, volatility. Then I guess, gold isn't the safe haven. I don't know what you're looking for, but gold isn't it. But I think there's two other ways of looking at safe haven. The first is that gold is not correlated to anything else in your portfolio. And you can run all kinds of analysis and all kinds of sophisticated statistical, stuff. And it turns out that a little bit of gold in the portfolio decreases portfolio volatility, increases returns, over long periods of time, but decreases volatility, which means smaller drawdowns, better Sharpe ratio. If you are a money manager and you're compensated for risk-adjusted returns, Sharpe ratio, you're going to live or die based on how you perform on that metric. Gold helps. So in that sense, it's safe, or it's adding some safety to the portfolio. But we emphasize a different concept of safe, which is default risk. The risk that you're going to lose your principal, not because the price is bouncing around all over the place, but because what you think is money good turns out to be not. And now you're a creditor in a bankruptcy proceeding and the creditors are getting, 5 cents on the dollar or whatever. And gold doesn't have that kind of risk. Whereas what we call money, which is actually credit, whether it's a dollar bill is the credit of the Federal Reserve. The Federal Reserve is an increasingly leveraged, almost hedge fund type vehicle. That's not a problem until it's a problem. Or whether you're talking about the credit of the Treasury, you're buying the T-bill, whether you're talking about a bank deposit, which is a general unsecured credit of a bank, these are credit. And there is a risk that the other party on the other side of it is unable to meet its liabilities, when mature. And that's the definition of insolvent. And so that can happen. It happened to Silicon Valley Bank. It happened to Credit Suisse. It will happen to other banks and other counterparties. And I think we're entering a period of heightened credit events. Gold is completely safe from that sort of thing. So no, I don't think it's lost its quote unquote safe haven status. So people ask, okay, you guys pay yield on gold, which is currently 4%. How does that change the equation? And what I would say to people is, yield is a paradigm shift. And a paradigm shift is one of those things that if you get it, you can describe it in a few words, while standing on one foot, as they used to say. But it's like saying to somebody, okay, imagine the world as it is, only we're going to tilt it 89 degrees. Now, can you picture that? And most people will say, yeah. But actually, it's hard to really think, okay, but that would mean, and this would mean, and what are all the implications of that? So, what do I mean by this? Okay, so gold having a yield, what that means is people are thinking about how much gold they have rather than how many dollars the gold is worth. The dollar is a defective, unit of measure. Now, I think most people realize the dollar is going down. So imagine measuring length using a meter stick, which is shrinking. So everything, the length of your foot, the length of your house, the length of your backyard is increasing. And then so you have, inflation adjusted length. I mean, it would be rubbish. You'd never be able to build a building that would stand. Certainly nothing taller than one story. So people understand that. But the other problem with the dollar is that it's volatile in both directions. Yes, it's generally shrinking due to debasement, but there can be wicked periods of volatility, certainly as we saw in 2001, in 2008, in 2020. Perhaps we're seeing it now, is that it can go the other way. So if you're using it to measure gold, you have this distorted perception because all economic values are quoted in dollars, including gold. You have this distorted perception that, okay, then this went down or this went up or whatever. It's not actually representing a change in that thing. It's representing a change in the meter stick. And, that can really, fool people. But what we find is that when people start earning interest on their gold and they see the amount of gold going up, of course, the account statement says it's worth this many dollars at today's market price. Everybody's going to demand to see that, obviously. But people, begin to focus on what really matters, which is how much gold you have. And in the short term, everybody gets all bent out of shape with the volatility and the price of gold as measured in dollars. In the long term, that doesn't really matter. That's noise. Ask yourself 20 years from now, is anybody going to remember, the volatility of October 21, 2025? No. They're going to say, yeah, gold is a $100,000 asset or whatever it is. And they'll be, if there's still $1 20 years from now, they'll still be thinking that way, probably, most of them. But for the people who know, if you know, you know. So to put this all in perspective, price of gold fell a little bit, fell back to, I think, where we were a couple of weeks ago. Gold has survived the volatility, the rise and falls of empires and kingdoms, military dictatorships, communist dictatorships, democracies, changes of monetary regimes, even when the country itself didn't fall, all kinds of different things. Gold is still there. It still is, what it always is. What it always was, and is still standing, today. So, in the strongest possible terms, I can say, think of economic values, measure them in gold rather than trying to measure gold or anything else in dollar terms, especially over long periods of time. If you want to say, what was this worth in 1910? And then people say, well, in inflation adjusted dollars, it's worth this today. No. In 1910, $20 was an ounce. Today, $4,000, $4,100 is an ounce. Use that to adjust economic values over long periods of time. Gold is the monetary equivalent of sea level. It's the objective value, not of altitude in this case, but of economic value. If what I've said makes sense to you and you're ready to start thinking in gold and start earning in gold on your gold, come to monetary-metals.com, give us a call, send us a web form, and you can start opening an account and get started today.